The first sentence must open on a named place and or a specific date from this story's world. The previous script opened with, in 2010, the most trusted automaker on Earth discovered. So this opening must be structurally different. No in-year company discovered. Pattern. On June 30th, 2025, Netflix shares hit an all-time high that valued the streaming giant at nearly $400 billion. The market believed the company had solved entertainment. It had $83 billion in trailing 12-month content spending. It had 280 million subscribers across 190 countries. It had the user data, the recommendation algorithms, the original programming machine that had killed linear television. The quants who modeled Netflix for hedge funds and pension funds saw a company with no peer, no ceiling, and no existential threat. 14 months later, those same quants were watching a 45% collapse in market value that had erased $260 billion. The company that could not lose had lost. The algorithm that knew what you wanted to watch before you did had run into something it could not predict. And the leadership structure that had seemed visionary for 2 decades suddenly looked fragile, exposed, and unprepared for the ground shifting beneath it. Here is where the story breaks from the standard corporate narrative. The collapse was not a single event. It was not one bad quarter, one failed series, one regulatory crackdown. It was the accumulated weight of 3 structural fractures the company's own culture had prevented anyone from naming. 3 fractures, 3 silences, each one built into the reward system, the meeting structure, and the performance review process that Netflix had invented and that the entire tech industry had copied. If you have ever sat in a meeting where you knew the strategy was wrong but said nothing because the room was full of people who had been right too many times, you already understand the first fracture. The Hollywood Reporter published an account of the power clash behind the crash. It described a company where the internal culture of radical candor had, paradoxically, created a silence more dangerous than outright censorship. Employees at Netflix are graded on a system called the Keeper Test. Managers are told to ask themselves, if this person told me they were leaving for a similar job at another company, would I fight to keep them? If the answer is no, the employee is let go. The system was designed to ensure only the most talented, highest performing people remained. It created what the company called a culture of excellence. What it also created was a culture where admitting uncertainty felt like failure. The Keeper Test is built on a binary judgment. You are either a keeper or you are not. There is no middle ground, for I am uncertain about the right path forward and I need help thinking through this. There is no category for I have a concern about subscriber growth in the European market, but I cannot yet prove it with data. The problem is that the most important strategic decisions in a company of this scale are never obvious in real time. They become obvious only in retrospect. The person who spots a weak signal early, the margin compression in a specific content vertical, the engagement decline in a key demographic, the competitive threat from a platform that does not yet exist as a direct rival, that person cannot prove anything. They can only raise a concern. In a culture where every conversation is a performance review, raising an unprovable concern is a career risk. This is not a theory. Edmondson, in 1999, studied 51 work teams and found that psychological safety was the single strongest predictor of learning behavior. Teams where members felt safe admitting mistakes and asking for help performed better on complex tasks. Teams where members felt judged for uncertainty performed worse. Dieter and Burris in 2007 found that employees speak up only when they perceive their supervisors as open and approachable. When the supervisor is also the evaluator of your performance, your keeper or non-keeper, the perceived openness collapses. Netflix built a culture of high performance. It systematically eliminated the psychological safety needed to sustain it. The second fracture was structural. When Reed Hastings named Ted Sarandos co-CEO in July of 2020, he made a bet that dual leadership would unlock the next phase of growth. When he named Greg Peters co-CEO in January of 2023, he doubled down on that bet. The co-CEO structure is rare in public companies for a reason. Bunderson and Sutcliffe, in 2002, studied 31 surgical teams and found that team coordination improves when roles are clearly defined and when members can speak up without fear. The opposite is also true. When roles blur, coordination degrades, and silence spreads. You just saw the pattern: high performance on paper, psychological safety in the trash. That inversion, where the thing you think is strength is actually the fracture, is exactly what this channel exists to find. If you want to keep seeing the hidden architecture behind every collapse before the suits figure it out, subscribe. And drop a comment. Have you ever worked in a culture that looked strong but made you afraid to speak up? I want to hear your story. Serendos was responsible for content. Peters was responsible for product and business. Hastings, as executive chairman, was responsible for strategy and board relationships. In theory, the division was clean. In practice, the three most consequential strategic decisions of the period after 2023, the password-sharing crackdown, the advertising tier launch, and the live sports pivot, required coordination across all three domains. Password sharing was a product decision that required content changes, that required business model renegotiations. No single person had complete authority. The three co-CEOs, by all public accounts, managed the tension professionally, but the organization beneath them did not. Regional heads reported to different co-CEOs for different matters. Content acquisition teams reported to Serendos' structure. Subscriber growth teams reported to Peters' structure. The two groups did not share meeting cadences. They did not share incentive metrics. They did not share the same definition of what a successful quarter looked like. When the subscriber growth that had driven the stock to its June 30th, 2025 peak began to slow, each team interpreted the data through its own lens. The content team saw a pricing problem. The product team saw a content problem. Both were partly right. Neither had the full picture. And the person who might have forced the synthesis, the founder who had built the company by making exactly those synthesis decisions, was transitioning into philanthropy. On April 16, 2026, Reed Hastings announced he would not seek re-election to the board when his term ended in June. The news was not a surprise. He had stepped down from the co-CEO role in 2023. He had been gradually reducing his involvement, but the timing, during a weak quarterly earnings forecast, with subscriber growth slowing and content costs accelerating, turned a transition into a crisis of confidence. Netflix's stock fell 9% in a single session. The analysts who had modeled Netflix as a $300 billion company with a founder-driven edge suddenly had to model it as a management-driven company with a co-CEO structure that had never been stress-tested. Here's the paradox that the market missed in that 9% drop. The structural fractures were real, the cultural fractures were real, but the quarter that triggered the collapse, the first quarter of 2026, was not a bad quarter by any objective measure. Revenue was $12.25 billion, up 16% year over year. Subscriber growth was positive. Operating margin was healthy. The collapse was not about the numbers. It was about the story. The story the company had told investors for 2 decades was that Netflix was uniquely positioned to dominate entertainment because of its culture, its data, and its founder. When the founder stepped away from the board and the culture began to show cracks, the story broke. Fraser and colleagues in 2017 meta-analyzed 136 independent samples and found that psychological safety is positively related to performance, information sharing, and learning behavior. The effect was consistent across industries, company sizes, and national cultures. The finding was not subtle, it was robust. Netflix knew this. The company's famous culture deck included a section on candor. It encouraged employees to say what you think, even if it is controversial. It celebrated the CEO who listened to bad news without punishing the messenger. But the culture deck was written in 2009. By 2026, the company had grown from 2,000 employees to over 14,000. It had expanded from a U.S.-based DVD rental business to a global streaming and production company with operations in dozens of countries. The culture deck had become a historical document. The actual culture was shaped by incentives, not by a PDF. The keeper test remained. The performance reviews remained. The internal competition for resources and attention remained. What had changed was the distance between the CEO's desk and the person with an unprovable concern. In 2009, that distance was a few steps. In 2026, it was 5 layers of management, 3 continents, and a compensation structure that rewarded certainty over curiosity. The person with the concern about the European content strategy did not have a forum to raise it. The person with the data showing engagement decline in the teen demographic was not in the same meeting as the person who set content budgets. The person who suspected that live sports would not drive the subscriber growth the market expected had no incentive to say so publicly, because saying so publicly would mean challenging a strategic bet that 3 co-CEOs had signed off on. That person was not afraid of being fired. They were afraid of being wrong in a culture that had no category for uncertainty. The third fracture was the deepest and the hardest to fix. It was not about culture or structure. It was about the problem that neither culture nor structure could solve. How do you make strategic decisions when you have too much data and not enough signal? Netflix had access to more viewer data than any company in entertainment history. It knew what you watched, when you watched, how long you watched, where you paused, what you searched for, what you abandoned after 10 minutes, what you finished in one sitting, and what you put in a queue and never touched. It had 280 million subscribers generating data every second of every day. The conventional wisdom was that this data gave Netflix an unassailable competitive advantage. The conventional wisdom was wrong. The problem with having too much data is that the signal-to-noise ratio collapses. When you have a million data points, you can find a pattern to support any decision. You can prove that viewers want more Nordic noir or less Nordic noir. You can prove that 60-minute episodes outperform 40-minute episodes, or that the opposite is true. You can prove that the algorithm recommends the right content, or that the algorithm reinforces a narrowing taste bubble that eventually pushes subscribers away. The data does not speak for itself. It is interpreted by humans with incentives, assumptions, and career risks. The structure that had enabled Netflix's rise was the same structure that prevented it from seeing its own blind spots. The co-CEO system distributed authority but diffused accountability. The keeper test selected for confidence but filtered out doubt. The data advantage produced more information but not more wisdom. And the founder who had once served as the final synthesis point, the person who could look at a conflict between the content team and the product team and say, here is the decision, here is why, now execute, was gone. You just watched how even a company with 280 million data streams collapsed under the weight of its own signal-to-noise ratio, because the one person who could synthesize it all was gone. That is the same trap the market set for you every day. More indicators, more noise, less actual edge. Subscribe if you want to learn how to find the synthesis point before the crowd loses it. And drop a comment. Type synthesis if you have ever trusted your own read over the algorithm, or noise if you still think more data is the answer. Reed Hastings did not leave because Netflix was failing. He left because the company had reached a stage where his skills were no longer the right match. That is a defensible decision. It is also a dangerous one for a company that had never developed an internal mechanism for strategic synthesis that did not rely on him. The risk was not that Hastings would suddenly vanish. The risk was that the organization had adapted to his existence. It had built decision-making processes that assumed a final authority existed who could resolve conflicts between the co-CEOs. When that authority left, the conflicts did not disappear. They just stopped being visible. The Hollywood Reporter piece described a power clash behind the crash. The Bloomberg coverage described a $260 billion wipeout driven by earnings risk. The Reuters coverage described a leadership transition that rattled investor confidence. All of them described a symptom. None of them described the cause. The cause was a company that had optimized for excellence and eliminated the psychological safety needed to sustain it. The cause was a structure that distributed authority but diffused accountability. The cause was a data advantage that produced noise disguised as insight. The cause was 3 fractures that no one in the organization felt safe enough to name. The question is not whether Netflix will recover. The question is whether the recovery requires the exact culture change that the current structure prevents. The company that could not lose had lost, not to a competitor, not to a market shift, not to a regulator, to its own architecture for making decisions. The keeper test could not save it. The data could not save it. The co-CEO structure could not save it, because the edge that Netflix had once held The ability to make bold, fast, centralized decisions based on a founder's intuition was not replicable through process. It was a human skill, concentrated in one person, and when that person left, the skill left with him. The market had valued Netflix as a $300 billion bet on that skill. When the skill walked out the door, the market repriced the bet. The lesson for any organization that has built its culture around a single brilliant decision maker is uncomfortable. The culture you design for one person becomes a liability when that person leaves. The data you trust becomes noise when the interpreter is gone. The structure you build to support a leader becomes a cage when the leader is no longer there to unlock it. You have felt this. Every trader who has ever followed a system built around a single rule and then watched that rule stop working knows the feeling. Every founder who has built a company around their own instincts knows the feeling. Every professional who has ever relied on a mentor, a framework, or a mental model that eventually aged out knows the feeling. The feeling is the moment when you realize that the system you trusted was not a machine, it was a person, and the person cannot be replaced by a process. The fractures at Netflix are not unique to streaming. They are the signature failure mode of any organization that scales fast enough to outgrow its own culture. The company that hired for brilliance and rewarded certainty built a workforce that could execute brilliantly but could not adapt. The company that centralized decision-making in a founder built a structure that could not make decisions without him. The $260 billion that evaporated from Netflix's market value was not a loss of revenue. It was a loss of faith. The investors looked at the organization and did not see a mechanism for strategic renewal. They saw a machine that could run its current trajectory but could not self-correct when the trajectory changed. The data showed that the trajectory had already changed. The password-sharing crackdown had produced a temporary subscriber bump, but the engagement metrics underneath were softening. The advertising tier was growing, but at lower revenue per user than the ad-free tier. The live sports pivot was expensive, and the returns were uncertain. The content budget was increasing faster than subscriber revenue. The organization had the data, it had the analysis. What it did not have was a forum where the people who saw the pattern could say, "I see a pattern," and be heard without being judged. That is the fracture that cannot be fixed by replacing a leader. It can only be fixed by rebuilding the culture that silenced the voices that the leader needed to hear. Here's what the evidence shows about the year the culture broke at Netflix. It was not 2026 when the stock fell and the founder left. It was the 2 decades before that when the culture was built on the assumption that the founder would always be there to synthesize what the organization could not. The fractures were laid in the foundation. The collapse was just the first moment they became visible to the market. The company that could not lose had lost because it had built a culture that could not learn from its own doubts. The algorithm that knew what you wanted to watch before you did had missed the most important signal of all, the signal coming from its own people. The question that lingers after the $260 billion repricing is not about Netflix specifically. It is about every organization that has copied the Netflix culture deck without understanding the hidden costs of its design. The keeper test spread through Silicon Valley like a virus disguised as a vaccine. Companies that had never operated at Netflix's scale adopted the framework because it sounded rigorous, because it promised to filter out mediocrity, because it gave managers a simple binary tool for complex human decisions. What those companies did not copy was the founder's intuition that had once balanced the test's harshness. They did not copy the informal conversations in the hallway where a director could tell Hastings that the European content strategy was wrong without fear of being marked as non-keepable. They copied the system. They did not copy the relationships that made the system work. The difference between a culture that can hold a painful truth and a culture that suppresses it is not in the policy documents. It is in the trust between the person who sees the problem and the person who has the power to act on it. Edmondson's research on psychological safety, published in 1999, was based on a study of 51 work teams in a manufacturing company. She asked a simple question: why do some teams report more errors than others? The intuitive answer is that teams reporting more errors are making more errors. The actual answer is the opposite. Teams reporting more errors have higher psychological safety. Their members feel safe admitting mistakes because they trust they will not be punished for honesty. Teams reporting fewer errors are not safer. They are quieter. The same dynamic played out at Netflix. The organization reported fewer strategic concerns over time, not because there were fewer concerns, but because the culture had trained people to hold them inside. The meeting rooms grew quieter. The executive summaries grew more confident. The data decks grew thicker, and the pattern that would eventually break the company, the misalignment between content spending and subscriber engagement, the cultural fractures that the co-CEO structure could not resolve, the strategic uncertainty about live sports that no one wanted to voice, grew in the silence. When the quarterly earnings report finally revealed the pattern, the silence broke all at once. The stock fell 9% in a day. The analysts downgraded their ratings. The journalists wrote the autopsy before the patient had finished the surgery, because the market does not forgive what the culture refused to name. But here is the part that does not make the headlines. The culture at Netflix did not fail because the people were incompetent. It failed because the incentive system rewarded the wrong behavior. The people who saw the fractures were not lazy or careless or uninformed. They were rational actors responding to the incentives they were given. If your performance review is a binary keeper or not decision, you optimize for appearing confident, not for being right. If your compensation bonus depends on hitting a subscriber growth target, you optimize for hitting the target, not for raising a concern about the method. If the people above you have been publicly celebrated for their strategic bets, you learn that betting big and winning is the path to promotion, and betting cautiously and being right is the path to obscurity. The incentives do not lie. They do not care about the culture deck. They do not care about the founder's vision. They determine behavior with the cold precision of gravity. The question for any organization that wants to avoid Netflix's trajectory is not whether you have a culture of candor. It is whether your incentive system rewards candor more than it rewards silence. Most companies cannot answer that question honestly because the answer is painful. The painful truth is that most organizations would rather maintain the fiction than rewire the incentives. If you want to keep seeing these invisible structures called out, the incentives that quietly rigged the game, subscribe now because we're only going deeper. And if you've ever been the one who raised the hand and got ignored, drop the word silence in the comments. Let's expose how many of us have felt that gravity. The answer exposes that the people who get promoted are the ones who execute, not the ones who question. The ones who get raises are the ones who hit targets, not the ones who warn that the targets are wrong. The ones who get the CEO's ear are the ones who I tell the CEO what they want to hear, not the ones who tell them what they need to hear. This is not a character flaw in the people who rise. It is a structural feature of organizations that reward certainty and punish doubt. And it is the reason why the most dangerous moment for any successful company is the moment it starts believing its own success is permanent. Netflix was not the first company to fall into this trap, and will not be the last. General Electric was the most valuable company in the world in 2000, with a culture built around Jack Welch's performance management system that ranked employees and fired the bottom 10% every year. By 2018, it had been removed from the Dow Jones Industrial Average after a series of strategic missteps that the internal critics could not voice. Enron had a performance culture that rewarded risk-taking and punished skepticism. It collapsed in 2001 when the risk that no one had dared to question turned into the largest bankruptcy in American history at the time. Blockbuster had a data-driven approach to its business that had allowed it to dominate the video rental market. It missed the streaming transition because the internal culture could not process a threat that did not fit its existing model. The names change. The pattern does not. The pattern is always the same. A company achieves success through a specific set of advantages, builds a culture that protects those advantages, and then discovers that the same culture prevents it from seeing when those advantages are eroding. The successful company is not killed by its competitors, it is killed by its inability to hear the people inside it who saw the competitors coming. The lesson for every trader watching this is uncomfortable and essential. The market does not care about your past success. It does not care about your conviction, your track record, or the system that made you money last year. It cares only about whether you can adapt to the moment you are in right now. The trader who made $100,000 last year by shorting meme stocks is not a genius. They are a trader who found a pattern that worked and then had to find the next one. The trader who loses 50% of their account in the next quarter is not incompetent. They are a trader who trusted a system that had stopped working and did not have the psychological safety to admit it to themselves. The most dangerous voice in your trading is the one that tells you to stay the course. Not because staying the course is always wrong, but because that voice is the same one that told the Netflix employees to keep executing the strategy that would eventually break the company. The voice sounds like confidence. It sounds like discipline. It sounds like the advice you would give to someone else in the same situation. But it is not any of those things. It is the internal keeper test, telling you that admitting uncertainty about your own strategy is a sign of weakness. The traders who survive over decades are not the ones who are always right. They are the ones who can say I was wrong and change direction before the market forces them to change direction. That skill is not taught in trading courses. It is not measured by win rate or Sharpe ratio. It is a human skill built on the same psychological safety that organizations need to thrive. The CEO who can hear bad news without punishing the messenger runs a company that can adapt. The trader who can admit a strategy is failing without ego collapse runs an account that can adapt. The structure that enables that adaptation is not complex. It is a simple rule. Create a space where the truth can be spoken without fear. Netflix had that space when it was 2,000 people and the founder was in the room. It lost that space when it grew to 14,000 people and the founder was no longer there to protect it. The lesson is not that growth is bad. The lesson is that the space must be built into the structure, not into the person. The market repriced Netflix because the investors realized the company had no mechanism for strategic self-correction beyond its founder. The same repricing happens to every trader who operates without a mechanism for self-correction beyond their own ego. The question is not whether you will face a moment when your system stops working. You will. The question is whether you have the internal culture to hear the signal that says so, or whether your own keeper test will keep you silent until the market speaks for you. The evidence is clear across every domain. The organizations that survive are not the ones with the most data, the most capital, or the most confident leaders. They are the ones with the psychological safety to hear the truths that the confident leaders cannot see. The algorithm that knew what you wanted to watch before you did missed the most important signal. The same algorithm lives inside every profitable strategy, every successful company, every winning trader. Do not wait for the market to force the signal out of you. Build the silence into your process before the silence builds itself into your outcome.